When it comes to achieving financial independence through passive income, in my opinion, there's no better option than relying on dividends. While other avenues like owning real estate properties, writing a book, or starting a blog exist for generating passive income, they often require significant effort and time to maintain. In contrast, living off dividend distributions from your investment portfolio is pretty straightforward. Consider this. If you invest in rental properties to earn income from tenants, you'll still have to deal with building maintenance, getting tenants, and potential eviction issues. Building a successful blog demands years of effort in growing a dedicated audience. Even ventures like licensing your music requires creating songs that people not only enjoy, but also are willing to pay for. However, with dividend investing, you receive dividends directly into your brokerage or bank account like clockwork, be it monthly or quarterly. It stands out as one of the easiest ways to secure a living income without the need for constant involvement. Aside from periodically checking your portfolio, it's basically a hands-off approach. This financial strategy could be your ticket to escaping a job you don't like and pursuing a more fulfilling career, or allowing you to shift from full-time to part-time work, granting you more time for family, friends, and personal goals. Nonetheless, the most significant challenge when aiming to live off dividends is the initial investment required. A quick search on YouTube or various financial and business websites will give you recommendations, many suggesting that you need at least $1 million saved up to retire early. Business Insider, for instance, claims that if you wish to retire by age 35 and earn $65,000 annually, you'd need a minimum of $3.3 million in your stock portfolio. Even retiring at age 65 might seem scary, with recommendations of needing $1.6 million for a yearly income of $65,000. These numbers may seem discouraging, especially for individuals who don't have vast sums of money saved up. However, I'd like to emphasize that there's a more accessible way for a more significant number of people to achieve the goal of living off dividends without needing $1 million portfolio or waiting until their 60s. We'll explore various investment options and determine the actual amount required to live off dividends, using a monthly income target of $4,000 as an example. Please note that this amount can vary significantly based on your circumstances. It may be much higher in expensive locations like Los Angeles or New York, but more manageable in more affordable areas like rural Tennessee. Let's begin by examining some popular dividend growth investments typically featured in these discussions. We'll use Johnson & Johnson, ticker symbol J&J, as an example. According to Yahoo Finance, J&J trades at $157.14 per share, has a yield of 3.06%, and pays a quarterly dividend of $1.19 per share. To generate $4,000 per month or $12,000 per quarter, we would need to divide $12,000 by $1.19, which yields approximately 10,085 shares. In this scenario, you would need to purchase 10,085 shares of J&J at $157.14 per share, requiring an initial investment of approximately $1.5 million to maintain your lifestyle through dividends. Now, let's consider more alternatives for a broader range of investors. I understand that the investment amount required for living off dividends, especially in stocks like Johnson & Johnson, can seem daunting and unattainable for many viewers. While it's true that you won't need to invest the entire $1.5 million up front and can accumulate this wealth over time through consistent monthly investments, there are significant downsides to this approach. One major drawback is the long waiting period. Relying on the dividend growth strategy means waiting for a stock like Johnson & Johnson, which currently yields only 3.06%, to increase its dividend every year for decades. This extended timeline can be demotivating, and many individuals may lose the drive to continue because of its protracted nature. It's a method that typically requires the majority of your working years to achieve, which may not align with early retirement goals. Therefore, considering the extended time frame and the substantial investment required for stocks like Johnson & Johnson, it might be worthwhile to explore higher yield investments. Let's take Realty Income, ticker symbol O, a real estate investment trust, REIT, as an example. Realty Income stands out with its 3.95% yield, surpassing many consumer staple stocks like Coca-Cola or Procter & Gamble. What's even more appealing is that Realty Income pays out dividends on a monthly basis, providing regular income. This REIT has a strong track record, having increased its dividend for 95 consecutive quarters, making it a reputable choice among REITs. Now let's calculate how much you'd need to invest in Realty Income to generate a monthly income of $4,000. By dividing $4,000 by its current monthly dividend of 0.2558 cents, we find that you'd need to own approximately 15,637 shares of Realty Income to achieve this monthly income target. Multiplying the number of shares, 15,637, by the share price, $50.06, gives us an investment requirement of approximately $782,788.22. While this is a significant amount, it's notably less than the $1.5 million required for Johnson & Johnson. However, it's still a considerable sum and may be challenging for many individuals to amass quickly. To explore an even higher dividend yield, let's consider a different stock. Altria, ticker symbol MO, is an American company known for manufacturing and selling cigarettes, tobacco, vape products, and alcohol. Currently, it offers an impressive dividend yield of 9.19%, paying out dividends quarterly, with a rate of 98 cents per share at the time of creating this video. To generate a monthly income of $4,000 or $12,000 per quarter from Altria, you'd need to own approximately 15,189 shares, considering its current share price of $41.99. This would require an investment of approximately $637,786.11. While this amount is still large, it's more attainable for many investors, especially if they stay committed, consistently invest in this stock, and reinvest the dividends over time. However, it's important to address a critical question. Is it smart to invest such a significant amount of money and rely solely on one stock for your financial well-being? The answer is no. Diversifying your investment portfolio is crucial to reduce the risk associated with relying on a single company. Overdependence on a single stock, even one as established as Altria, exposes you to significant risks, especially if that company were to reduce its dividend payouts, as seen with AT&T in the past. While diversification is essential, it's challenging to find company stocks with dividend yields comparable to Altria's. This leads to the question of where to invest for exceptional dividend yields, increasing distributions, and monthly dividend payments. One attractive investment option in this regard is covered call ETFs. Covered call ETFs are a relatively newer investment type that has gained popularity. They utilize a covered call investment strategy, involving purchasing a basket of stocks and selling call options corresponding to that stock basket. These call options are sold on a monthly basis, and the premiums collected from these options are distributed to investors in the form of dividends. This results in high dividend yields. One of the most popular covered call ETFs is QYLD, which has a 11.21% dividend yield. Additionally, there are two other notable covered call ETFs, JEPI, which employs covered calls while also holding equity-linked notes for stability, and NUSI, which uses covered calls and protective puts to reduce risk against significant market downturns. While JEPI and NUSI offer slightly lower dividend yields compared to QYLD, they tend to have better long-term price appreciation. As demonstrated in the graph, a $10,000 investment in QYLD 5 years ago has outperformed Johnson & Johnson, particularly when dividends are reinvested. This makes covered call ETFs an attractive option for those seeking substantial and consistent dividend income. Now let's calculate the amount you'd need to invest to generate an annual income of $4,000. We'll start with NUSI. If we divide $4,000 by the last monthly dividend of this fund, which was 13 cents, we'll need to acquire approximately 30,769 shares. Multiplying this by the current share price of $28.73 gives us a total of $620,918.41. While this beats Altria in terms of required investment, it's important to note that NUSI is not a diversified ETF, as it doesn't rely on just one company. Now let's turn our attention to QYLD. By dividing $4,000 by its last dividend of 0.157 cents, we find that we'd need approximately 25,477 shares. If we multiply this by its current share price of $16.81, we arrive at a figure of $428,628.37. Remember, you don't necessarily need to invest this entire amount up front. By reinvesting your dividends each month and allowing the snowball effect to work its magic, your required initial investment will be significantly lower, depending on how patient you are. For instance, if you can sustain yourself on $2,000 per month, perhaps due to other sources of passive income like Social Security or a retirement account, you'd only need about $250,000 initially. This approach seems much more attainable than relying solely on stocks like Johnson & Johnson. In my opinion, investing in covered call ETFs alongside other stocks and living off the dividends offers a more feasible path than, for example, trying to write a best-selling book or making substantial income by selling stock photos or jewelry on platforms like Etsy. Even if you can't completely replace your income with dividends, earning an extra $1,000 or $2,000 every month can significantly improve your financial situation. I hope this video has showed you that it's indeed possible to achieve financial independence through dividends much earlier in life. Covered call ETFs have revolutionized the game for those looking for high and consistent monthly dividends. For more information, you can explore the subreddit QYLDGang, a community of thousands of investors embracing these ETFs for early financial freedom. It's worth noting that this approach carries some risk, is subject to higher taxes, and requires diligent portfolio diversification. Nevertheless, the benefits are well worth it. Whether you decide to pursue dividend investing for growth or income, the most important step is to start. The sooner you begin investing in dividend stocks or ETFs, the closer you'll be to building a nest egg you can rely on. That concludes today's video. Thank you all for watching. Your support is greatly appreciated. If you found this video valuable, please consider hitting the like button below and subscribing to the channel. This feedback helps me gauge the interest in this type of content, and I'll continue to provide more dividend investing strategy videos accordingly.